The advisor who helped you when you had $500,000, they might not be equipped to address the advanced strategies required when your wealth grows to 3 million, 10 million, or beyond. But it's not always obvious until you see what's missing. And that gap can show up in taxes, estate planning, and family security. So today, here are 10 signs you may have outgrown your current advisor. Let's go. Number 1, missed opportunities in tax and charitable planning. Let's start with one of the biggest areas, taxes. They're often the single largest expense wealthy families face. If your advisor isn't integrating advanced tax strategy, there's a gap. This is where proactive planning really matters. Roth conversions, when done with purpose, could help balance future tax brackets and may reduce surcharges. Tax loss harvesting is also a valuable tool, especially in volatile markets, and it may allow you to use short-term downturns to potentially create long-term tax benefits. And when it comes to generosity, coordinating charitable giving with gifting appreciated stock could create meaningful efficiencies, providing deductions in higher income years while allowing you to gift those shares that have appreciated the most. This approach may let you give more strategically, avoid unnecessary capital gains, and direct support to the causes that matter most to you. Then there are state-level considerations. Some states impose estate taxes. We're looking at you, Illinois, well below the federal exemption. And retirement distributions may be taxed differently depending on where you live. Families with multiple residences need coordination across jurisdictions sometimes. Reason number 2, your advisor doesn't address insurance. Another area that's easy to overlook is insurance. It may not always be top of mind, but it can play an important role for wealthy families, especially as wealth and complexity grows. Let's start with umbrella liability coverage. As your wealth grows, visibility often grows too, and coverage levels may need periodic review to stay aligned with your current situation. From there, consider life insurance. It's not just about replacing income, it may also provide financial continuity for a spouse or a family member who manages the household. And then there's the long-term care planning. Addressing it early when you're younger could reduce stress later on in life and may provide more flexibility when care decisions eventually arise. Taken together, these coverages may support your overall financial strategy, especially when they're revisited as your life and goals change. The third reason, family continuity isn't always discussed. Now let's talk about something every family should consider, continuity. If the spouse who handles finances passes away, is the other spouse suddenly forced into a crash course during their grief? Planning should aim to make sure the surviving spouse isn't left overwhelmed. Clear processes, education, and family meetings will reduce that confusion. Number 4 reason, annual planning and stress testing are missing. Planning is something you don't do once and forget. It works best when it evolves over time. Goals-based planning keeps your objectives front and center, so decisions stay tied to what matters most. And then look at cash flow modeling, taking a year-by-year look to see whether your plan appears sustainable. And you also better be stress testing, which allows you to model both strong markets and challenging ones to see how your strategy might hold up. Even when projections look solid, portfolios may still need adjustments to keep them aligned with your goals and your risk tolerance. Reason number 5, your executive compensation is overlooked. Executives often have concentrated exposure through their benefits packages. When it comes to stock options and restricted stock, understanding when and why to sell can be just as important as knowing how to sell. Thoughtful, tax-aware execution, timing sales carefully may help reduce unnecessary taxes. And also, benefit optimization matters too. It can be valuable to review the full menu of benefits, not just the investment accounts, to see how they work together as part of the bigger plan. Item number 6, your estate planning is not integrated. Let's shift gears into estate planning. Trusts are often the tool of choice, but only if used thoughtfully. ILETs for insurance, charitable remainder trusts for charitable intent, generation skipping trust for multi-generational planning, and most importantly, coordinating with your attorney, not siloing your advisors and experts. At Puzzle Well Solutions, when we help families implement trust, we factor legal costs into your first year fee schedule because planning should be holistic, not additive. Reason 7, your portfolios are limited to traditional investments. Another sign you've outgrown your advisor is being limited to traditional investments. Adding private credit and other alternatives may help broaden income sources for you, but also diversify where the returns come from. Including institutional real estate could also help reduce your reliance on public markets and potentially smooth portfolio volatility over time. Number 8 reason you might have outgrown your advisor: there's no business exit strategy discussions. If you're a business owner, planning years in advance can be super important. Think first about net proceeds. How much do you need after taxes, debts are paid off, and banker fees if a liquidity event occurs? Then consider key person coverage while you're running the business. You need insurance, maybe disability and coverage to help support continuity and work towards protecting business value if something happens to a key person. Finally, review your transition strategy. Build a structure that could support your retirement and help make that handoff of the business as soon as possible. The 9th reason, you are still acting as the middleman. If you find yourself constantly relaying messages between your CPA, your attorney, and your advisor, maybe a sign that something is missing. Ideally, your advisor coordinates directly with your other professionals so that level of integration can help reduce gaps and support a more efficient overall process for you. And number 10, limited support resources. Finally, let's talk support. Is your advisor working with just one assistant or maybe even sharing an assistant across multiple teams? At Puzzle Well Solutions, we have 6 dedicated support members. That means your needs are often addressed the same day or by the end of the next day. Need funds wired, checks ordered, tax forms sent to your CPA as you approach the tax deadline? If I'm with a client and can't answer you right away, someone on our team will. To wrap this all up, if several of these signs resonate, it may mean you've outgrown your current advisor. At Puzzle Well Solutions, we help families address complexity with structure and a coordinated team. If you'd like to explore what this could look like for your family, you'll find a scheduling link in the description. Until next time, stay informed, stay proactive, and take control of your retirement.